wondered how companies like Google get those crazy valuations.
Mm-hmm.
Or even something closer to home, like how a real estate agent figures out what your house is worth.
Yeah.
Well, today we're going deep into the world of valuation.
Okay.
Exploring the methods and strategies used to figure out, what something's worth.
Right.
Especially for companies at different stages of their journey.
Right. It's a fascinating area because certain core principles always apply, whether we're talking about, a huge tech giant
Right.
or a local business.
Exactly. And to help us out today, we're using excerpts from the Little Book of Valuation by Aswath Damodaran.
Great book.
He's a leading expert in the field.
Oh, yeah. He really knows his stuff.
And we'll be breaking down his insights on everything from discounted cash flows to those, multiples you always hear analysts talking about.
Oh, yeah. The PE ratio and all that.
Exactly. And we've even got some real-world examples.
Awesome.
Using companies like Under Armour, Hormel Foods.
That's right. And even ExxonMobil.
Wow. So by the end of this deep dive, you'll have a framework for understanding how a company's value is determined.
Right.
This will not only help you, spot potential investment opportunities, but even, allow you to kind of think critically about market valuations and maybe even spot some inconsistencies.
That sounds incredibly useful.
Yeah, absolutely.
So where do we even begin with something as complex as valuation?
Well, I think a great starting point is understanding intrinsic value.
Okay.
It's about looking beyond the current stock price and really understanding the true worth of a company based on its future cash flows and the inherent risks involved.
So it's like looking under the hood.
Exactly.
Not just judging a car by its paint job.
Precisely. Think of it like evaluating a rental property.
Okay.
You wouldn't just look at the asking price, right?
Right.
You would consider the potential rental income.
Factor in things like maintenance costs.
Right.
And the risk of vacancies.
Yeah.
Intrinsic value does the same for companies.
So if we can understand a company's intrinsic value, are we better able to determine if the market is, overvaluing or undervaluing it?
Absolutely. That's the power of this approach.
Okay.
It allows for a more informed and independent judgment about a company's worth.
That makes a lot of sense.
Yeah.
But I know there's also this concept of relative valuation.
Yes.
Where you're basically comparing companies to their peers. Is that right?
That's right.
Is this just kind of a shortcut?
It can be seen that way.
Okay.
Relative valuation, using metrics like the price to earnings ratio or the PE ratio can provide a quick benchmark. Yeah. Especially, when you're dealing with companies that have been around for a while. Think of it like, checking the sale prices of similar houses in your neighborhood.
Gives you a general idea.
So using those comps is kind of like a quick sanity check.
Right.
But I imagine there's a risk of oversimplification.
There is. You can't just blindly rely on averages.
Right.
Each company, just like each house, has unique qualities that impact its value.
Okay.
Would you value a rundown fixer-upper?
Yeah.
The same as a newly renovated home?
Right.
Just because they're the same size?
Definitely not.
Exactly.
So how does this all play out when we consider that companies are constantly evolving? I mean, they go through different stages.
That's right.
Kind of like a life cycle.
Yeah.
Right.
That's a great observation and a key point that Damodaran emphasizes.
Okay.
He breaks down valuation across the company life cycle from young, high-growth companies to, mature companies and even those facing decline.
Okay.
Each stage has its own, set of challenges and opportunities.
That's interesting. So let's start with those young companies. They're often full of potential, but also carry a lot of risk.
That's right.
So what are some of the key things to consider when valuing them?
Well, you got to remember with young companies, historical data might be limited. They might have small revenues or even be operating at a loss.
Okay.
Plus, the failure rate's much higher in this stage.
Right.
It's like trying to predict the future of a seedling. It might grow into a mighty oak.
Yeah.
Or it might wither away.
That sounds tricky. So instead of traditional metrics like earnings, what should investors focus on?
Damodaran suggests focusing on revenue growth, projected operating margins, and perhaps most importantly, their probability of survival.
Yeah.
He uses Evergreen Solar as a good example.
Okay.
They were a young company, a lot of promise in the solar energy sector, but they ultimately failed.
Wow. So it's a high-risk, high-reward situation.
Exactly. You have to consider not just how fast they're growing, but how sustainable that growth is.
Right.
And whether they have a solid plan to achieve profitability.
Okay, let's move on to companies that have moved past those initial, high growth years, but are still expanding.
Okay.
How does the valuation approach change for them?
Well, these growth companies are facing new challenges as they scale.
Okay.
They need to manage competition, adapt to, evolving market dynamics, and kind of refine their risk profile.
So it's kind of like the awkward teenage years of a company.
Right. That's a great analogy.
Figuring out who they are and where they fit in.
Damodaran uses Under Armour as an example.
Okay.
They were, phenomenal success story.
Right.
But as they got bigger, maintaining that rapid growth became more difficult.
Yeah.
Investors had to start looking at how their growth, their margins, and reinvestment needs might change over time.
So the focus shifts from pure growth potential to sustainable growth and profitability.
Exactly. And this requires a deeper dive into factors like the scalability of their business model, the strength of their competitive advantages, and their ability to generate consistent returns on the capital they reinvest.
All right, that makes sense.
Yeah.
Now, what about those companies that have reached, maturity?
Okay.
The ones with established market positions and consistent profits.
Right.
It seems like valuing them would be a lot simpler.
Well, while mature companies might appear more stable, their valuation still hinges on understanding, their potential for change.
Okay.
Can they optimize their operations? Can they unlock hidden value through acquisitions or strategic shifts?
Right.
Even established companies need to adapt and evolve.
So it's not just about looking at their current performance, but their potential to, generate value in the future.
Think of it like buying a house that needs renovations.
Okay.
You wouldn't just look at the current state,
right,
but its potential value after fixing it up.
Yeah.
It's about understanding the potential for improvement and growth, even in mature companies.
Damodaran uses Hormel Foods as an example, right?
That's right.
They're a well-established food company.
Oh, very well established.
But he points out that even they can be impacted by factors like, management changes or shifts in consumer preferences.
Absolutely. Assessing the quality of management and their ability to adapt to a changing landscape is crucial, even for companies that seem like safe bets.
That's fascinating. We've talked about young, high-growth companies, those navigating the growth phase, and even those, mature giants.
Yeah.
But what about companies on the decline? Is there even a point in trying to value them?
That's where things get really interesting.
Okay.
Valuing declining companies comes with its own set of challenges.
Okay.
You have to factor in the risk of further decline, potential bankruptcy, and the possibility of asset sales or restructuring.
Right.
Think of Sears, once a retail powerhouse.
Oh, yeah.
They struggled to adapt and ultimately filed for bankruptcy.
So valuing declining companies is a bit like trying to salvage a sinking ship.
That's a great way to put it.
You need to assess the damage.
Yeah.
See what can be saved. And figure out if it's even worth the effort.
You have to carefully evaluate the risks and potential rewards.
Right.
Some investors actually specialize in finding value in distressed companies.
Oh, wow.
Betting on their potential for a turnaround.
So far, we've journeyed through the life cycle of a company.
Yeah.
But I know there are also those, unique situations that require a different approach to valuation. Can you tell us more about those?
Of course, Damodaran highlights several special situations.
Okay.
And we'll start by looking at financial services companies.
Okay.
Like banks and insurance firms.
Right.
What makes them unique is that they operate under different accounting rules.
Okay.
Making it trickier to define their debt and cash flows.
So they're kind of a different animal.
They are. They're also subject to strict regulatory capital requirements.
Okay.
That impact their ability to grow and take risks.
So instead of relying on traditional methods like free cash flow analysis, what does Damodaran suggest for valuing financial companies?
He recommends focusing more on equity valuation.
Okay.
Using models like the dividend discount model or the excess return model.
Okay, so valuing banks is almost like speaking a different financial language.
In a way, yes.
Okay.
He uses Wells Fargo as an example, highlighting the importance of analyzing their regulatory capital buffers, operating risks, transparency, and competitive landscape.
It sounds like valuing financial firms requires not just, financial expertise, but a deep understanding of the regulatory environment.
You're absolutely right.
Okay.
It's a specialized area that demands a different approach compared to, your typical manufacturing or retail company.
Okay. What other unique situations should we be aware of?
Another interesting category is cyclical and commodity companies.
Okay.
Their earnings tend to be volatile, swinging up and down with, economic cycles or commodity prices. Take oil companies like ExxonMobil or Petrobras. Their profits are heavily influenced by the often unpredictable price of oil.
So how do you even begin to value a company when its earnings are on a roller coaster ride?
Well, one approach is to, normalize earnings, adjusting them to reflect a more average or sustainable level.
Okay.
Another is to carefully consider, those cyclical fluctuations when projecting growth rates.
It almost sounds like you need a crystal ball to predict the future of the economy or commodity prices.
We can't predict the future with certainty, but we can use historical data, analyze supply and demand dynamics, and consider a range of potential outcomes. It's about managing uncertainty, not eliminating it.
All right, that makes sense. So we've covered financial companies, cyclical companies. What's the final category of these special situations?
The last category is companies with significant intangible assets.
Okay.
These are assets that don't always show up clearly on a balance sheet, but can be incredibly valuable.
Okay.
Things like research and development, brand equity, patents, or even customer relationships.
That's interesting.
Yeah.
I can see how those things would be hard to put a precise dollar value on.
Absolutely.
What are some examples of companies with a lot of intangible assets?
Think of companies like Amgen, the biotech giant, or Amazon with its massive customer base and brand recognition. These assets aren't always reflected accurately in traditional accounting methods, which can lead to distortions in a company's reported earnings and book value.
So how do you account for these hidden gems when valuing a company?
Damodaran suggests capitalizing and amortizing expenses related to these intangible assets. It's basically recognizing that investments in things like R&D today will create valuable products and services or brand recognition in the future.
Can you break down what capitalizing and amortizing means in this context?
Sure. Capitalizing means treating those expenses as investments rather than just costs. And amortizing means spreading those costs over the useful life of the intangible asset.
So instead of just expensing the cost of developing a new drug all at once, you would spread it out over the years. That drug is expected to generate revenue.
Exactly. This gives investors a more accurate picture of a company's earnings, reinvestment, and the true value of its assets.
I see how that makes sense. Damodaran uses Amgen as an example, right?
That's right.
By capitalizing their R&D expenses, their earnings and book value were adjusted upward, reflecting the future value they were expected to generate from those investments.
And remember, the impact of this adjustment can vary, significantly, depending on the lifespan of those intangible assets. A longer useful life means a bigger impact on earnings and book value.
So consistency in applying this approach is crucial when comparing companies within the same industry.
You don't want to be comparing apples to oranges.
You need to make sure you're using a consistent approach to account for those intangible assets.
Exactly.
Great point. We've now covered intrinsic and relative valuation, explored the company life cycle, and even tackled those special situations. But before we move on, there's one more element that Damodaran throws into the mix.
All right.
Stock options.
Yes, stock options.
It sounds simple enough.
The
right to buy company stock at a set price in the future. But they can add a layer of complexity to valuation.
Yeah.
Why is that? I mean, they seem like a good way to incentivize employees and align their interests with shareholders.
They can be, but they also dilute existing shareholders' ownership. If employees exercise their options, new shares are issued.
Okay.
And that reduces the value of each existing share.
Ah, I see. So it's like adding more slices to a pie.
Exactly.
Each slice becomes smaller.
Right. So how do we account for this potential dilution when valuing a company?
That's a great question. I'm curious to hear what Damodaran suggests.
Well, he presents 3 approaches for dealing with stock options, each with its own level of, complexity and accuracy.
I'm all ears. Let's dive into those approaches and see how they impact valuation.
Sounds good. The simplest approach is the, what's it called? The diluted shares method.
Okay.
This involves just assuming that all options will be exercised.
Okay.
And adjusting the number of outstanding shares accordingly.
Okay, that sounds straightforward enough.
Yeah.
But what are the, the limitations of that method?
Well, it tends to undervalue a company because it ignores the cash proceeds that the company receives when employees exercise those options.
So it's like forgetting that.
Exactly.
Those extra slices of pie actually bring in money when they're sold.
That's a great way to put it.
Right. So we're missing part of the picture there.
Yeah.
What's the next approach?
The second approach is called the treasury stock method.
Okay.
And it attempts to address this by incorporating those exercise proceeds into the valuation.
So it's a little more...
Yeah, it's more realistic.
They're realistic, okay.
But can sometimes overvalue the company.
Why would it overvalue the company?
Because it ignores the time value of money.
Right.
An option that's, out of the money today might never actually be exercised.
Right.
So assuming its full potential value now doesn't quite reflect reality.
So it's like assuming that a lottery ticket is worth its full potential payout.
Yeah.
Even though the odds of winning are slim.
That's a great analogy.
Yeah.
This brings us to the third approach, which is, more complex, but arguably the most accurate.
Okay.
It involves using an option pricing model to actually estimate the present value of the options.
Right.
Taking into account factors like the exercise price, the time until they expire, and the volatility of the underlying stock price.
So instead of assuming the options are either worth their full value or nothing, this approach factors in the probability of them being exercised and the time value of money.
Precisely. And Damodaran uses Google with its significant stock option grants to illustrate how these 3 approaches can lead to very different valuations.
Okay, so we've covered a lot of ground here.
We have.
From discounted cash flows to multiples, life cycle stages, those special situations, and even the nuances of stock options.
Absolutely.
What are some of the, key takeaways you hope our listeners will walk away with?
I think the biggest takeaway is that,
valuation is a process, not a destination.
Okay.
It's about using these different tools and frameworks to build a well-informed perspective, not just finding a single right answer.
That makes sense. It's more about understanding the story behind the numbers, right?
Absolutely. Another crucial takeaway, the interconnectedness of risk and growth.
Okay.
Higher growth often comes with higher risk.
Right.
And this dynamic is essential to understand when making investment decisions.
So those eye-popping growth projections might sound tempting.
Right.
But we also need to be realistic about the likelihood of them coming true and the risks involved.
Exactly. And let's not forget about context.
Right.
The same valuation techniques might not apply equally to, a young tech startup.
Right.
And a well-established industrial giant.
Yeah, it's like using different tools for different jobs.
Exactly.
Right. You wouldn't use a hammer to tighten a screw. Precisely. And finally, it's important to remember that markets are not always efficient.
Okay.
Prices can fluctuate for various reasons, driven by emotions, speculation, or sometimes just plain old human error.
So that means there are opportunities for investors who can identify those discrepancies between a company's intrinsic value and its market price.
Valuation can be a powerful tool for uncovering those opportunities.
This has been incredibly insightful.
It has.
Now let's, put what we've learned into practice for our listeners out there.
Yeah.
think about the companies you're interested in. What stage of the life cycle are they in?
Right.
What are their key value drivers? Can you spot any inconsistencies in how the market is valuing them?
That's a great exercise.
Right.
It's all about applying these concepts to real-world scenarios.
Right. So if we're looking at, those young, high-growth companies, the focus should be on scrutinizing their revenue growth projections, understanding their path to profitability, and crucially, assessing their likelihood of survival.
Absolutely.
And as those companies transition to a more mature phase, the focus shifts to sustainability.
Right.
Can they scale their operations efficiently? Can they maintain their competitive edge? How are their reinvestment needs and returns on capital likely to evolve?
That's a lot to think about.
And for those mature giants, it's all about looking beyond the steady earnings and understanding their potential for change. Can they streamline their operations? Make strategic acquisitions, find creative ways to unlock value.
Exactly. And let's not forget about companies facing decline. The key there is to carefully assess the risk of further deterioration and weigh that against the potential for a turnaround.
And of course, those special situations, like financial companies, cyclical companies, and companies with significant intangible assets require us to, tailor our approach and select the right tools for the job.
Absolutely. Don't be afraid to challenge conventional wisdom. Delve into those financial statements and use these valuation tools to develop your own informed perspective.
This is great advice.
Thanks.
And it's, a continuous learning process, right?
It is.
Valuation isn't a one-time exercise. It's an ongoing journey.
The market is constantly changing.
Yeah.
And so should our understanding of how companies are valued.
Okay. I think we've done a fantastic job of, equipping our listeners with the fundamentals of valuation.
I hope so.
But before we wrap up, I want to leave them with a thought-provoking question.
Okay.
That builds on what we've discussed today.
I'm intrigued. What's this final challenge?
Well, we've talked extensively about, valuing individual companies. But what about valuing entire markets? The stock market, for example, is essentially a collection of companies, each with its own intrinsic value. But what factors influence the overall value of the market?
That's an excellent question. One that moves beyond simply looking at individual companies. It brings in concepts like macroeconomics, investor sentiment, and even global economic trends.
Exactly. Things like interest rates, inflation, economic growth, geopolitical events, they can all influence investor behavior.
That's right.
And drive market valuation.
Up or down.
Up or down.
Imagine interest rates are rising.
Okay.
That might make investors demand higher returns from stocks, which could lead to lower valuations across the board. Or think about a period of economic uncertainty, and investors might flock to, safer assets, essentially pushing down stock market valuations.
And then there are those unpredictable events. Like wars, pandemics, or natural disasters.
Absolutely.
That can just send shockwaves through the global economy.
Totally.
And really impact market sentiment.
It's a complex interplay of factors. And there's no single formula for valuing the entire market.
But by understanding these broader forces, we can gain a deeper appreciation for how markets function.
Absolutely.
And how they react to, changing conditions.
So as we analyze individual companies, we should also keep that bigger picture in mind.
Right. How do current valuations compare to historical norms? Are there any macro trends that could be influencing investor behavior?
That's a fantastic point.
Right.
It's like zooming out from a single piece of the puzzle to see how it fits within the larger picture.
Exactly. And by developing this, more holistic view, we can become even more informed investors.
Absolutely.
Whether we're, focused on specific stocks or considering broader market trends.
I think that's a brilliant note to end on.
Agreed. We've empowered our listeners to, think critically about valuation from individual companies to the market as a whole.
To the big picture.
But before we sign off,
I
want to emphasize one final point from Damodaran.
I'm listening. What's this parting wisdom?
Damodaran reminds us that the ultimate goal of valuation isn't just about arriving at a specific number.
Right. It's about understanding what truly drives value. And then, using that knowledge to make smarter investment decisions.
It's not enough to just, plug numbers into a formula.
Exactly. You need to grasp the underlying story those numbers tell.
Right. Are they sustainable?
Right.
Are there hidden risks or opportunities the market might be overlooking?
It's all about digging deeper.
It strikes me that this is where, experience and judgment really come into play.
Absolutely. Valuation provides a framework.
Okay.
A set of powerful tools, but it's not a crystal ball.
Right. You need to be able to interpret the data, weigh different factors, and ultimately make, informed decisions based on your own assessment.
It's a bit like learning to read a map.
Okay.
The map itself doesn't tell you where to go.
Right.
But it helps you understand the terrain, navigate the landscape, and chart a course to your destination.
I love that analogy.
It's a good one.
And just like a skilled navigator, a good investor needs to be, adaptable, resourceful, and willing to adjust course as new information emerges.
Couldn't have said it better myself.
So as you venture out into the world of investing, armed with your newfound understanding of valuation, remember to stay curious, challenge assumptions, and never stop learning.
Absolutely.
This has been an incredible deep dive.
It has.
Into the world of valuation.
We covered a lot.
We covered a lot of ground.
Yeah.
From the basics of intrinsic value to those complex scenarios involving stock options and intangible assets.
Yeah, we really went deep.
Hopefully our listeners are feeling, empowered.
I hope so.
And ready to tackle those investment decisions with a fresh perspective.
And remember, valuation is a continuous journey.
Yes.
Not a one-time event.
Right. As markets evolve and companies adapt, so too should our understanding of how value is created and measured.
That's a fantastic point to end on.
Keep exploring, keep learning, and keep diving deeper into the world of finance.
Yeah. Until next time.
Until next time, happy valuing.